bringing you the latest in tax credit news, insight, and analysis. This is Tax Credit Tuesday with your host, Michael Novogradac.
Hello, I'm Michael Novogradac, and this is Tax Credit Tuesday. This is the May 6, 2025 episode. My guest this week is Lance Smith. Lance is a Novogradac partner who works in the Bay Area out of our Petaluma, California office. Lance is here today to discuss the opportunities, risks, and challenges faced by for-profit housing developers when they enter into a joint venture with a not-for-profit affordable housing developer. Now, in a future episode, I do hope to have Lance back to discuss the inverse, that being the opportunities, risks, and challenges to a not-for-profit affordable housing developer when they joint venture with a for-profit. Now, Lance is an expert on the topic. I don't think you'd be tuning in if you didn't think I was having a guest to be expert on the topic that we're discussing. But one reason why I say he's an expert is he's the lead editor on the second edition of the Novogradac Nonprofit Housing Developers Handbook, which was, not coincidentally, released a few weeks ago, and it is now available for purchase at www.novoco.com. Now, if you want to learn more about the topic we do discuss today, I encourage you to purchase the Nonprofit Housing Developers Handbook. I also encourage you to call Lance with any additional questions. There's plenty to talk about. We're not going to cover all the issues, obviously, in the handbook, but just to give you a sense of some of the issues discussed in the handbook, we have Lance on here today. So if you're ready, let's get started. Lance, welcome back to Tax Credit Tuesday. I can't believe it's been 2 years since you were a guest on the show.
Well, thank you. Thank you, Mike. And thank you for the reference to the recent release of the Nonprofit Housing Developers Handbook. I do hope the users find it useful in understanding various issues that are unique to working with nonprofit developers.
And hopefully your time on the podcast 2 years ago wasn't so difficult that you didn't want to come back. So hopefully I'll be back sooner than 2 years to cover the other episode that I foreshadowed in the introduction.
That was quick lock-in there, wasn't it?
Exactly. But before we start, beyond editing the Nonprofit Developers Handbook, please tell our audience a bit more about the services you provide to Novogradac clients.
Like I say, I work with a number of developers, and I also work with a number of nonprofit organizations, but I do have a particular emphasis of working with nonprofit developers. So I think this allows me to see the various opportunities and risks and challenges they face and face with working with them.
So let's start with a description of the housing developer landscape. Please share with our audience how common it is for profits and nonprofit developers to joint venture in a lawfully tax credit transaction.
These are actually quite common due to many of the aspects we're going to discuss today.
Okay, well, let's start discussing them. And we'll start with the opportunities presented for profits and nonprofits to joint venture. And when we were preparing for this podcast, we identified numerous opportunities, and we decided we'd focus on 3, with the first of the 3 being a better chance of winning an award of lawfully tax credits. Please explain how a nonprofit developer's participation helps a particular property win an award of lawfully tax credits.
Okay, so the biggest thing is that nonprofits already have out the gate, the tax code provides 10% of all awards being allocated to a nonprofit. So if you're able to participate or joint venture with that nonprofit, that puts you in that particular pool. In addition, the nonprofit's going to be able to provide, gets additional points for a ROFR, that's a right of first refusal. You might also have resident service plans that the nonprofit can bring in that get additional points in the process.
No, those are good examples. And I'm sure a lot of our members of our audience are thinking about all the other ways in a given state, how nonprofit participation can aid in getting points or being eligible for certain set-asides and the like in order to increase your chances of getting an award. So it is very state specific, but safe to say that oftentimes a joint venture with a nonprofit does increase the chances of a tax credit award directly and indirectly, which we'll talk about the indirectly more in a moment. But one of the second opportunities relates to lower property taxes. Please share with our listeners why in many states, California maybe is the best example, where virtually all LIHTC transactions involve a joint venture with a tax.
So that, yeah, California it does stand out as its welfare exemption that it provides for nonprofits, that it provides this tax exemption that your property tax gets tax exempt. So by lowering your property taxes, you're going to lower your overall operating costs. By lowering your overall operating costs, it gives you two options. You can either increase your permanent loan because your operating income is higher, or you can be able to provide lower rents to tenants for lower income populations, or you can even do a combination of those two.
And that's the reason why, like in California, it's virtually universal that a nonprofit is involved in the transaction. And we're seeing that in more and more states as states are trying to find ways to make affordable housing more financially feasible. And then the third opportunity relates to access to soft financing. Please explain this benefit to our listeners. I'll also note that access to soft financing beyond making a project financially feasible also in many states increases your chance of getting an award. And that's the indirect benefit
Yes.
that you sometimes have by being with a nonprofit. They can bring in soft financing.
Yeah, I mean, that's heavily the problem I see trying to close the gap, how to get that additional extra financing because the standard financing isn't enough. So a nonprofit can often come in with a variety of federal, state, or even city grants, and/or loans and you can even have potential benefit from the other charitable organizations, or even benefactors interested in a tax deduction that the nonprofit's able to give them as a charitable donation. So these are often grants upfront, or they could be soft debt financing that either has soft terms. We say soft debt financing, mean that cash flow, it's dependent on cash flow. If there's not enough cash flow, then the debt just keeps being deferred. They're usually very low interest rates. And so it would come from residual cash flow, or even just not even be due until the end of the loan term. And that loan term can often be much longer than a traditional 30-year loan.
So thank you for that.
And
And
like I say, also in addition, that nonprofits also are very connected with their local communities as well. So that helps make those connections. An example I could share of that would be a county making a land grant to the nonprofit that then it can be used for development.
thank you for that. There are other opportunities we could be talking about. Maybe I'll be back to talk about the other opportunities as well. But I wanted to segue into some of the risks. And once again, in preparing for the podcast, we discussed two risks, the many that we could talk about. And the first relates to the definition of tax-exempt use property and how, if you're joint venturing with a nonprofit, you run the risk of partnership assets being created as tax-exempt use property, which can lengthen the depreciation lives and the like. And longer depreciation lives mean a delay in losses being allocated to your investor, which kind of adverse impacts on equity pricing. So if you could kind of unpack what tax use property risk is and how that risk can be avoided.
And this is a complex issue. I think I watch a lot of people get hung up on it. And I'll say,
Let me just say, to interject here, we'll do this at a very high level. Don't get into the details too much. Don't become a code head, but describe it at a high level, and our audience can reach out to you and look to the handbook for more specific detail.
No, definitely the handbook I directed, it will give a much more detailed description of what we're covering today. But to give a kind of brief background to understanding how it comes, I'd say a typical, my experience is typical LIHTC developer's dream is the investor comes in, puts in a bunch of cash, gets the credits, losses, and then quietly disappears after 15 years, while the developer is able to keep the developer free up front and any cash flow from operations, and definitely at the back end sale or ownership of the property. So nonprofits are no different. They're going to argue for the same kind of things. The problem is when you start changing the income and distribution allocations. So the LIHTC partnership is typically going to be the 99.9% of losses and credits to the investor, but the general partner nonprofit entity wants the cash and property at the end. So structuring the partnership with these changes will trigger a tax rule that you referenced to as the tax-exempt use property. and this tax-exempt use property then is longer loss, appreciable life. So the depreciation expense is going to be slower over the period of time, and then they're not going to be eligible for the bonus depreciation,
Right.
which I know many investors are very excited about. So to the solution to that, the tax code does provide a mitigating issue, and that's the creation of a for-profit blocker entity owned by the nonprofit. So, but this requires very careful planning and timely execution to be effective. So I strongly recommend bringing in your accountants very early and make sure that they know what that is. And this whole process is known as the Section 168H6 election. And I could say a personal example I had was a nonprofit organization that came, they were partnering with a co-partner, and they wanted, I think the co-general partner was wanting to know where this election was. It had not been made. And so fortunately, we were able to reach a positive solution, but it took a costly private letter ruling from the IRS to finally get it in place. But had we been in there from the beginning, it would have
Exactly.
been a much more straightforward process in making the proper elections and filings. So.
And at some level, when we were talking about this as a risk, it was you have to make sure that you know to do this, but you also have to make sure that it actually happens.
Yes.
So a for-profit wants to make sure that they get evidentiary matter that the election's been made. And then similarly, the not-for-profit, needs to make sure they're working with their tax advisors to ensure that it does get made. So the second issue, which is also in some ways a tax issue, but it's maybe an indirect tax issue, and that's that earlier on you mentioned that there is this 10% set aside of annual 9% tax credits that needs to be awarded to joint ventures with the nonprofit general partner. And that nonprofit general partner has to materially participate in the partnership on a regular, continuous, and substantial way, both during development and operation. So with that as background, please share with our audience some of the steps that they should undertake to ensure that they are meeting, that the nonprofit is meeting the material participation standard.
Yeah, so all of the issues we've discussed are contingent on the nonprofit having that material participation. And you did hit the right three keywords that the tax code emphasizes and focuses on. It's regular, continuous, and substantial. And that's pertaining to the involvement of not just the development, but operations all the way through the life of the activity. So in case you're curious, I should throw out there that limited partners are not considered material participating. So nonprofits must serve as a general partner in this relationship. But if the challenge there is that the failure of the nonprofit to materially participate, it could result in the loss of the property tax exemption, or even a more extreme, if there's more of an abusive relationship, you could have private inurement issues, and that could result in significant penalties and potentially a nonprofit losing its exempt status.
Well, then there's also the foundational question of if you qualify for the 10% set aside, but then you don't comply with it,
Right.
consequences of that. And that's a question you don't want to have to try to figure out what the answer is.
I agree.
So we've discussed the 3 opportunities and 2 risks. Want to now turn to challenges. And once again, we're following a pattern here. We had lots of challenges. We decided we focus on 2. And the first of the 2 challenges was ensuring that both parties understand who's responsible for what, or as we were saying, what's the responsibility of the for-profit and what's the responsibility of the profit. Please.
So
go ahead.
Yeah, definitely sorting out those responsibilities are important, and who's making the major decisions. Again, if the for-profit's making all the decisions, is the nonprofit still meeting that requirement of regular, continuous, and substantial participation? And in particular, there's aspects that come up that focus on the guarantees. These typically, housing development will have various guarantees that come up right at the beginning. This includes the construction loan, who's responsible for guaranteeing that, the construction completion, and even the operating deficits, particularly in the early phases of the operation. So another aspect is even determining the allocation of the developer fee itself, if you're co-developing.
Right. And you can only imagine a lot of other issues. And it's just important to make sure that you're identifying as many other responsibilities as you can and defining them and how issues will get resolved and the like. And then the second challenge that we wanted to discuss had to do with the negotiating the terms of the exit after the end of the tax credit compliance period, because you're the standard LIHTC partnership, maybe the level set for our audience. It's going to be 15 years, 10 plus years of claiming the tax credits, 5 years for recapture burn off that last 5 years. And I say 10 plus years because whatever shortfall credits in year one get claimed to year 11, and then you have 12 to 15. Then usually at the end of year 15, there's talk of the investor partner leaving, but you still have the nonprofit and the for-profit together. And at that point, they have to, up front, they need to be looking at that end and identifying what's going to happen. Please share what some of the options are for an exit.
Yeah, so you certainly want to ask, these are questions you ask up front. Will the property, how are you going to wind up this relationship? Are you going to keep the property? Are you going to do that under co-general joint ownership in perpetuity at some point? Or is the property going to be sold? Or will the nonprofit continue to hold it, potentially under the ROFR, that first right of first refusal that we referenced before, or some other potential arrangement on that? And again, with the nonprofit, they've got their mission, and the for-profit has their mission as well. So trying to work those questions out in advance are very important.
And I would just note that when you're thinking of rights of first refusal, there's both market rate rights of first refusal and below market rights of first refusal. Oftentimes nonprofits, as you know, Lance, would like to have a below market right of first refusal. If a for-profit is bringing in a nonprofit, they generally don't want to give them a below market right of first refusal. And then, similarly, a nonprofit is bringing in a for-profit to help in ways that we'll talk about in some future episode. The nonprofit generally will want to have a below market right of first refusal, so they know that they can control the property at the end of the tax credit compliance period.
Yeah, that's very correct.
So there's a lot more we can talk about. In fact, we have the entire handbook that covers all these issues, as I've mentioned multiple times in the course of the podcast. And I do look forward to having you back to flip the discussion and be more focused on some of the reasons why nonprofits will be reaching out to for-profits to joint venture. But before we move on this version, is there anything else our audience should know?
I think we've kind of hinted at there that early discussions, and I would say a strong MOU, or that memo of understanding up front, which is a precursor to the partnership agreement. It's clear to have that. The more clearly that is documented, the less issues you're going to experience down the road. I've found that 15 years is plenty time for the originating individuals to have moved on and their replacements not knowing about the original verbal agreements or handshakes that may have been made. So anything is clearly documented and understood by both parties of expectations. There are fewer surprises and far less ruffled feathers. Could do that. I'd say that the second issue, again, I mentioned that earlier, is bringing in accountants early. The earlier we know the deal structure, the better we'll be prepared to be able to timely implement the terms, particularly this as 168H6 election. Which, by the way, I can just say is not actually made by the partnership itself. It's just made by the general partner entity. So
I'm glad that you mentioned that, because that's one of the ways it slips through the cracks is
yes.
that nonprofit needs to make that election in their return, not the partnership. So the partnership and the for-profit might be thinking it's been made, but never have evidentiary matter that it was made. And then lo and behold, it didn't get made. Then you're doing a private letter ruling and all the rest.
Yes.
And I'd also note that when you mentioned bringing in accountants early, when we were preparing, we were discussing how it's really bringing your professional advisors, but the attorneys are always in there early because they're negotiating the agreements. It's bringing in the accountants, particularly the tax accountants, in early. So they're ensuring that everyone understands what the filing requirements are and the like.
And that's definitely the joke I have with when I talk to my clients' accountants side on in-house people. There's like, we're always the last to know too. So, so yes, make sure that even in-house people as well as your external.
I really appreciate your point about it's not just your external accounts. It's not just bringing Novogradac, but it's also make sure that those within your organization that will have responsibility for this are aware.
Yes.
Lance, I will share your email address in today's show notes so folks can reach out to you. I'll also share a link for our audience members interested in the Nonprofit Housing Developers Handbook. And I do want to remind our audience, later this week, I'll be at the Novogradac 2025 Urbanizing Conference here in San Francisco. And if you're listening before Thursday, it's not too late to register. And the link to registering will be in the show notes. Now, before we get to the off-mic section, let me remind you to subscribe to the podcast in whatever platform you prefer. And please do share the podcast with your colleagues. Those of you who are watching on YouTube, I encourage you to like and comment on the video. By doing that, you help raise our visibility, and it helps others in the affordable housing community hear and see important discussions like the one Lance and I are having here today. And there is a list of the So You Want to Be a LIHTC Developer episodes on our YouTube page. This is, guess what number this is in that list? 27th episode on that list. Additionally, we have a full archive of all of the episodes of Tax Credit Tuesday on our website at novoco.com. Now we've reached our off-mic section, and we like to use this space to give a shout out to someone working in one of the many community development areas that we work. We get to highlight a professional deserve and earned recognition. Lance, who would you like to shout out?
It's a lot of people could shout out to, but I would certainly start with the nonprofit developers as a whole. I've worked with many of them. They do a great job. If I had to choose one individual that does immediately come to mind, I would choose Laura Archuleta. She's the president and CEO of Jamboree Housing. I've been able to admire her service for a number of years, and I've always been impressed with particularly the passion and enthusiasm she shows for her work. I think she's an excellent example of the dedication that nonprofit developers have as a whole to their profession.
Thank you. Excellent shout out. I echo your shout out to Laura Archuleta with Jamboree Housing. Lance, thank you for being on the podcast today.
You're welcome. Thank you.
And to our audience, I'm Michael Novogradac. Thanks for listening and/or thanks for watching.
This weekly podcast has been brought to you by Novogradac and Company, LLP. Archived podcasts are available online at www.novoco.com/podcast or by subscribing to the Tax Credit Tuesday podcast in iTunes, Spotify, YouTube, Google Podcasts, Stitcher, and Radio Public. You can find related links referenced in this podcast on our website at www.novoco.com/podcast. Novogradac and Company, LLP is a national certified public accounting and consulting firm with offices nationwide. Learn more about our professional services at www.novoco.com.